I had majority of my money in commercial real estate at the peak of the market, and I got my ass kicked.
Mm.
Luckily, I was diversified in good projects prior to that. Underwrite the deal, care a little bit less than what the structure is. If you get a 90-10 split and zero fees on a crappy deal from a new operator, you can go ahead and invest in that. I would
Yeah.
rather invest in a fat structured deal for the GP, but have it be a fat deal overall. The rent growth is just not there. Better not be 2.5%, 3%. Just chuck that in the trash. I'm not even gonna waste my time doing that.
What is up, everybody? We got another episode in our hands, and today I've got Lane on the show. Lane, thanks for coming on, man. I'm looking forward to this.
Yeah, thanks for having me. Aloha, everybody.
Yeah. So, can you tell everybody, who is Lane and what you're all about?
Yeah, I am a real estate operator, and now we're doing private equity, buying businesses, over $2 billion of past acquisitions. But originally, 2009, I was an engineer. Was taught to go to school, study hard, and buy a house to live in, and do that 401k stuff. And that was where I bought a house to live in. But I was in my 20s back then, so I didn't have
Mm.
kids, didn't have a spouse, and I was traveling all over for work, right? Like I was that George Clooney guy in Up in the Air for a while, and I just on a whim decided to rent out my property and just live on the road on the company expenses, and that was kind of where I realized, wow, this rental real estate thing is pretty cool. Bought a couple more rentals in Seattle a couple years later, and then by 2015 I had 11 rental properties, and then I kind of expanded off to apartments, etc.
Are they all just single family homes?
Yeah, the first 11, I guess there was a duplex in there, but yeah, primarily single family homes, which, I tell people especially if you're a higher income earner, you're going to progress through those stages a lot quicker than the average
Mm.
Joe out there who's going to flip houses for 15 years and, get 5 rental properties. So, it's probably best to stick with single family because you can sell it to a retail owner occupant and
Sure,
get out of it quickly.
sure. What kind of engineer were you?
I was an industrial engineer, so up there in Seattle, all of them go and work for Boeing, but I was not a
Hmm.
good engineer. I was not very good academically. I had like a 3.0 GPA. So I went to project management doing construction, right? Started to build
Okay.
a railroad, worked for BNSF Railway, and then um, just managed people and did that.
Yeah. Similar. We have similar backgrounds then. I was kind of a project manager myself in construction, industrial construction. We did a lot of work in steel mills, power plants, refineries, stuff like that. Ironically enough, I watched the documentary last night about Boeing. It was on Netflix. Are you familiar with it?
I've been to I mean, we did site tours of it. I mean, it's kind of cool. They always keep the plane moving at like 1 inch per hour or something like that. I mean, it kind of
Hmm.
resembles like a slave factory where how it just keeps the assembly line keeps moving. Probably an
Yeah, it was
industrial
pretty.
engineer figured out how quick it needs to go, right?
Yeah, exactly. Um, yeah, and same thing. Like I started. Well, I was flipping houses. I didn't do the rental thing, but looking back, I wish I would have done what you did, buying rentals. And I talk about it on the podcast all the time. Like if you want to be wealthy, real estate is where it's at. So is most of your properties stateside or?
Yeah, I mean, from the start, I mean, the first few rentals were Seattle, Washington, very blue state. I kind of got turned on to the whole if you're a landlord, you might as well be in the landlord friendly state. So that was kind of where I branched out to Alabama, Texas, Georgia, Indianapolis. Um, Certainly bought the apartments out in those red states. But yeah, I mean, it's kind of funny now we're kind of coming back to some of the blue states these days, right? But,
Mm,
like, yeah, that was a lot of, I think the big thing for investors is you got to get around not being able to touch and feel your properties. Because I mean, really, what are you gonna do? Especially when you get
mhm,
more than a dozen
mhm,
properties.
mhm. How many doors do you have now?
I don't know. I don't know. I mean, we had 10,000 at the peak. So got rid of a bunch, sold, and I mean, I'm guessing maybe few grand, a few thousand, something like that.
Wow. Now, are you solo or did you syndicate deals or how were you able to grow a portfolio? Technically in 15 years, that's very quick to get that many units.
Yeah, I mean, the first 7 years I did it all myself, buying the little single family homes, getting up to 11 of them. That was kind of my aha moment when I started to meet other accredited investors and started to realize, like, yeah, they own rental properties just like me, but they were dumping theirs because they didn't want the headaches, they didn't want the legal liability, and they didn't want the debt in their name. So I kind of followed a lot of people down that road to, jumping into syndication deals as a passive, and then as a GP. Um, but that was around 2016, and that's when we really started to play with gasoline at that point.
Mm,
But
mm,
I think the hardest part of wealth building is the first 100 grand and then the first million.
mm. Yeah, totally. When you're looking at deals, you're still looking at apartment buildings, I assume?
Yeah, I mean, they're getting harder and harder to pencil, that's for sure.
Mhm. Mhm.
Like first thing first, I mean, you got to work with the right people, that's for sure. So we don't work with anybody, we don't have a personal relationship or operate the deal ourselves. But as far as like, due diligence, I mean, we just take the P&Ls and rent rolls and put into our own analyzer and
Mm,
spreadsheet. I think the key thing here is using the right deal assumptions to make sure that you stress test the numbers. And like people can put whatever projections they want, but there are a handful of cells in the spreadsheet that really move the model upwards and downwards. So those are like the reversion cap rate, the increases per year, the annual escalators, and then how quickly you're pushing rents in a typical multifamily value add. A lot of things for passive investors, it's hard to evaluate, like, what are the comps, what are the
yeah.
rental comps? That's, I think you have to kind of put some trust in your GP, but at the end of the day, you're all aligned in a way. That's what I like about the syndication model. But when our model is like, we take in a lot of deals, we evaluate them, and we're able to somewhat normalize all these lofty projections
Mm.
with more reality. And then from that point, we're evaluating projects more on an apples to apples basis with, our assumptions on the deal built into our underwriting, and then, pick the best one overall.
So talking about assumptions, I'm curious as to your point of view with some of those, projections that you do plug in. What do you usually put in for rent escalation, expense escalation, inflation, all of that stuff, your exit cap rate? How many basis points do you usually try and jump per year to your exit from your initial going in?
Yeah, let's break down the biggest one, the reversion cap rate. For people who don't know that, you don't really care what the property is doing, right? Like what I do is I look at the prevailing market, right? I'm assuming that you bought this property under distress or it's a special snowflake, and that's why I don't care what the cap rate of that property is. I want to know, if for similar vintage in the same submarket, what would be assets selling for in this today? What is the prevailing cap rate today? So, an example would be like, say, like in Phoenix class, let's just say class C in Phoenix in a certain submarket for like 1970s property, you know, yeah, great. You bought a property for a 7 cap. But again, like I mentioned, that I don't care what you bought it at, right? Like I just care what properties at 1970s in that submarket in Phoenix are selling for these days. I mean, I'm just, guessing here, right? But
Sure.
I think today maybe it might be in like the six, let's say six, right, for discussion
Mhm.
purposes. Um, that's the prevailing cap rate. It traditionally, as conservative underwriting is taught, you want to increase the reversion or exit cap rate. Um, don't ask me why. Just go do the math on your own. When the cap rate increases, the property sells for less, right? Because the price
Mhm.
of properties is the net operating income divided by the cap rate. So you want to you don't know what the future is going to bring. So you normally want to be more conservative. So you increase the reversion cap rate, which sounds counterintuitive, but that means the price is downplayed and more conservative.
Mhm.
So normally, if you're, it depends on the business plan, right? And that depends on the markets, right? But if you're planning on holding this thing for like 5 years and doing a value add, I might increase the reversion cap rate by at least a quarter point, maybe a half a point today.
Mm.
Um, but like different rules for 3 years ago, right? I
Mhm.
think right now, cap rates for this type of asset class in Phoenix over the last decade or 2, 3 decades drift between, when something like this would trade for like the low fives, maybe even the high fours at some point at the peak of the market. And now it's
Mhm.
like 6, 6.5, like you're at the peak of that little undulation. So
Yep.
you get different opinions. Some people would say, well, keeping the reversion cap rate the same today is somewhat justified. It defies the laws of normal traditional conservative underwriting, but this is where people are split across the land, right? Like, do you increase your reversion cap rate now that you've just had a correction and prices have possibly bottomed out 30% or even 40% in some locations than what it used to be?
Mhm.
And maybe historically we've never really seen these types of assets trade for more than seven,
Mhm.
right? But
Mhm.
that's at the end of the day, I'm just trying to pick the best project I see within a range of other deals, right? And again, I'm not saying that, I just want to use all the same similar number, right? If I mean, just so happens we're evaluating 10 Class Cs in the same Phoenix market, which never happens, you would just throw in like, a reversion cap rate of like 6.5 or whatever. And if you normalize it to all of the deals you're looking at, then at least you can compare apples to apples, right?
Sure. Right. Most of the deals that you're sourcing, do you get them off market? Do you go through brokers? Because I've been finding like if you're working with brokers, a lot of times, I mean, I feel like in the last 5 years, especially, owners and brokers have just thought that their properties are worth way more than they actually are. I mean, there was some markets where properties were trading at 3.5 caps, which is insane. Now we're starting to see a little bit of correction in the market, but when you do your, like you said, your underwriting, most sophisticated investors are going to do that conservative underwriting. And even if they're only doing 10 basis points, a year during their hold period, that's only a 0.5% over a 5-year hold on the exit cap. If you bought it at a 3.5 or a 4, and you're saying, well, at an exit, it's going to be 4.5, but now things are trading at a 6, at 6.5. Holy shit, you're completely underwater now on that deal. You overpaid for that deal, and now you're holding it for 15 or 20 years just to try and recoup your deals. And I feel like a lot of brokers and owners were pushing that because the market was so hot for so long. So how do you get through that with brokers or owners, or are you just finding off market deals and on your own?
Well, I mean, it's not whether you're on market or off market. I don't think it really matters. It matters just what the distress level of the individual, right? Like, I mean, their note could be coming up due, um, and they need to sell, right? Because their alternative would be to put in $5 million, which they don't have, to limp the deal along for 15 years, which is not a good ROI for that 5
Mhm.
million.
Mhm.
So everybody's in a different situation. At the end of the day, it's like dating, right? Like, I don't know. I mean, we haven't done that many deals the last year or two. A lot of these deals just don't pencil. So we haven't
Mhm.
really pulled the trigger on that many. But at the end of the day, like, you're not going to apply the same rules that you did a few years ago today if you want to do deals. If you want to sit on your high horse and you're totally fine putting all your money in T-bills, then that's fine. You don't have to do anything. But at some point there will be a meeting of the buyers and sellers mind where there is a transaction strike price where a deal gets made. But ideally, you have to find the people who have some type of financial distress in there so that they're more motivated. I mean, this is no different than the simple mentality of like single family home distress buyers.
Mhm. Mhm. Yeah. So you're really watching the market, and you're watching the loan maturity dates on some of these assets that are out there.
Yeah, but I think the hard thing and the biggest thing why we haven't really pulled the trigger on too many of these is like the rent growth is just not there. I mean,
Hmm.
if you're underwriting like a Phoenix or Austin, like there's just negative rent growth, and you better be taking that into your assumptions at least for another year or two. Um, we have properties out there, and we're still giving like 3, 4 months of concessions, free rent away, and it
Really?
doesn't seem to be burning off. I mean, maybe there's some signs that the light's at the end of the tunnel of that stuff, but
Hmm.
you know, you I mean, if somebody plops a fresh PDF in front of me, that's the first thing I go look at, especially if it's one of those markets that got overbuilt, like Phoenix or Austin, is what are they using for their annual rent escalators? Better not be 2.5, 3%. That's for sure. I just chuck that in the trash. I don't even waste my time doing that.
Hmm.
But yeah, I think that's the big issue. But going back to 2021, that was a green light, right? Like, going back to the argument that you said, yeah, if you look at it just from one dimension, you're exactly right. But at the same time, rents were skyrocketing. And
Hmm.
even if you use something conservative like 3% a year, which is kind of justified at the time,
Hmm.
obviously you wouldn't use that today, right? But at the time that was very within reason, and the numbers penciled, right? But then now I think the problem today is the prices still haven't come down to that certain strike point, and the future outlook on rent increases is not there in the short term.
Yeah, 100%. And plus, wages are not keeping up with some of this inflation, so people are they can't afford their homes. I mean, I had family members that lived in Florida that were renting, and their one bedroom apartment was $2,000. I mean, that's crazy for
Right.
Florida. Florida's nuts.
Right.
So
Yeah, the K-shaped economy, right? I mean, the
yeah.
few are doing well, and the people on the lower end are just getting demolished. I mean, at the same time, they can't afford houses to buy,
Mhm.
so maybe they go to apartments. But yeah, they're just getting beat up too.
Yeah, totally. And so you, and we've been talking about this, me and some of my other colleagues. Um, we were talking about this 3 years ago that we were anticipating some negative rent growth, cap rates not staying where they're at. Is there any markets that you're seeing, if you even want to share, that are performing well?
I'm not gonna share it because that's kind of dumb of me doing that. People can
Hmm.
waste 2 years of their life and try stuff that doesn't work. But what I'll say is like, I mean, look for the markets that didn't get overbuilt in like the 2021. Because what happened was, I mean, we were developers too, right? We developed a couple of these larger apartments ourselves, and I mean, we're in this wave of like, oh my goodness, there's free money essentially. These loans, they're amazing, let's take advantage of that like everybody else. And so we got building in 2020, 2021, and then interest rates went up like summer of 2022. They didn't really get up to that point until early 2023, where it was like, oh my goodness, it crossed over that crossover point where I mean, I'll just use our example today. Like we have some tracts of land that we're not developing, that we're just sitting on, because
Hmm.
from a business perspective, it passed that point where a construction note, it doesn't pencil. Like I can't pay 13, 14% on a construction note and make money on that thing. So I'm just gonna sit and wait and sit on my land and land bank at this point. And it's logical, and that's why everybody that's why you don't see any damn cranes up in the air right
Hmm.
now. So everybody was feeding at the trough, and there was way too much building, and markets like Phoenix and Austin are notorious for this, right? They're very cyclical. People and the institutions will blame them, go in there and they build like a mother, and they create this oversupply thing that we're seeing right now, and it's not getting absorbed as quickly as everybody thinks or thoughts, which is why you have negative rents, and you have
Hmm.
to give away like pretty much a third of the year for free to
Hmm.
renters, which will turn at some point, right? Maybe that's next year, maybe it's the year after, who knows. But The opportunity is in these more tertiary markets that didn't get overbuilt, right? So you want to take your chat GPT and ask like, hey, can you figure out which markets didn't have, or rank all the major markets, all 150 of them, rank which ones had the most new supply hitting online in 2024 and 2025 and 2026. What I would do is look at those bottom markets that didn't really have anything on there. Of course, the issue there is now you don't have the potential for nice market growth there, right? Because they're more
Mm-hmm.
linear type of markets as opposed to cyclical, like a Vegas, Phoenix, and Austin, to name a
Mm-hmm.
few.
Mm-hmm.
But I think that's maybe where the opportunity is. I mean, they're the first ones who are gonna, kind of come back from this. But it forces you now to, that you're gonna have to wait for the market. So you maybe tack another year onto your deal. These markets, you better not be underwriting 2.5, 3% rent growth, right? Like these are more sleepier, quiet markets. Maybe even a 1.5% is more appropriate in those markets. So
I
that's
mean,
obviously.
you're on the PE side. How do you, in your syndicating, how are you convincing investors or institutional capital to come into these tertiary markets? I mean, that was one of the things that we had trouble with was we were finding deals in some of these tertiary markets, had a couple of them locked up, and some of the institutional capital backed out at the 11th hour because they were like, no, this is too tertiary for us. And it's like, but these are some of the most stable markets compared to the larger MSAs.
Yeah, I mean, I don't think our investors just blindly follow us,
Mm,
but I like to think that they are sophisticated and they think like us and a little bit more black and white. It's like, well, let's just depends on, doesn't matter where it's at, right? I mean, it depends on where it's at, right? Like we'll use different rent escalators and different growth project, different comps, right?
mhm,
But at the end of the day, like I don't, and I'm covering my eyes right now. Like I don't care where it's at, right? As long as you underwrite it appropriately for the location and potential growth, I just want to see where the numbers fall, right? In a way, it's
mhm,
kind of like a blind underwriting exercise. And if the numbers work, then and you're going in with, long-term debt too, by the way,
mhm,
that's not going to
mhm,
expire on me in under 5 years,
mhm,
then, well, what's the worst that can happen? Well, the worst can happen is we just be in this thing for 10 years and we cash flow a low single digit, you know?
mhm.
I mean, it's a different risk reward profile than, you're going in with bridge debt into Phoenix and,
Yeah,
you could possibly be out doubling your money in 2 or 3 years in the good times, but you get totally blown out of the water in the bad times, which, less we've learned that lesson ourselves too, right? Like, I
yeah,
mean, if you haven't, you probably didn't do anything in the last 5, 10 years.
yeah.
So I would say that's the kind of way I think our investors are looking at, because that's the way we look at these types of deals.
Mhm. So speaking of returns, what are what do you typically look for in terms of returns on a deal that you think it's a good deal to go after?
I mean, I try to like look for like 100% return in 5 years, or like 15 to 20% a year on average,
IRR or just ROI?
just ROI.
Okay.
But like it totally depends on how you underwrite it, right? What kind of assumptions? I can get whatever number you want by changing
Yeah,
certain cells in the spreadsheet.
yeah.
But I think, from our perspective, we like try and underwrite conservatively. And of course, for the listener, who the heck knows what that is, right? Really, what's going up in my
Mhm,
head,
mhm,
but, you know, it, we put in assumptions that we can sleep at night and it pencils at certain number, then I think we're going to move on to the next level with it and taking a little bit closer look.
mhm,
Some deals people get audacious on, certain um, deal assumptions and comps, and it, drops it from 112% return down to 60, right? That would be a no bueno, right?
mhm.
And that's what we've found is a lot of times it just doesn't pencil, it's not worth the risk, right, to get
Sure.
involved in something.
Yeah. Um, do a lot of your investors look more for the depreciation versus the return?
I mean, I think there's a little bit misnomer with that. Like, I think unsophisticated investors think of real estate as like a tax haven. In
Mhm.
reality, all that you're doing is deferring taxes with the stuff. You get to pay the piper when the deal exits, and hopefully you had a windfall. But yeah, I would say,
Unless you 1031.
yeah, but you can't 1031 from a syndication to syndication.
Mm,
Some people like to set up those types of deals, but then I, as an LP, putting my LP hat on, I don't want to be stuck to an operator in their deal, in their 1031 DST or 1031 deal. I think
mhm,
that's a bad deal for me.
mhm,
So I think the investors, I mean, yeah, certainly you're doing a cost seg, you extract out passive activity losses, and some of these guys have rep status, but a lot of people do not. These days, if you got a tax problem, you look to other mechanisms such as oil and gas investments. People want to talk about that. We can go offline on that. But yeah, I certainly think most of these tax strategies are just deferring mechanisms, and that's what real estate is. There's very few mechanisms where you can knock out taxes, such as oil and gas investments. Opportunity zones is another one, but I don't like
mhm,
opportunity zones at all because they're typically in garbage areas and very
mhm.
outlandish, high risk deals. Um, but yeah, I think most of the investors I talk to today they're just, I mean, a lot of them are, are business owners that have sold their business, and they need to reallocate
Yeah.
their asset classes. So, and they're like, well, that's maybe I'd like 10-20% in real estate, right? So that's why I'm coming here. But
Mhm.
again, I'm not a financial planner. I'm not, and apparently I've been told I cannot talk about that pie chart of the asset allocation mix, right?
Yeah,
Like,
yeah, yeah,
so, um, so that's just, I mean, I don't give people financial advice, but that's just from my point of view, like what they're telling me is like what they're trying to do.
sure. Um, Now on the deals that you have, that you operate, are you managing them yourself, or do you have a third-party management company?
So when the ones that we will operate, we typically like third party property management company. I mean, there's pros and cons, right? There's people are big on this divide. The BS that people will tell you is like, well, we get to run our own house and we get some cost savings, but then from an LP's perspective, I'm like, BS. That's you guys just want to catch your 10% contractor's fee and pocket that. And a lot of these guys, you got to catch them because they'll pocket that really quickly.
Yeah.
And sometimes they don't even do the work and they pocket the money sometimes. I like that separation of church and state in a way, and I don't want my syndicator operator to be in the pocket of the PM firm. I like them to
Mhm.
be independent to some extent. And then, in our past, like, man, we just go through property management firms like no other. I mean, maybe we're bad operators, but I like to think that, like, I mean, we've worked with like, I think, I don't know, I can't say their name, but like the top 5 property management firms out there in terms of size, and they don't like working with us because I think they would prefer to like work with like more stabilized assets than to do the value add thing, because it's a bad job
Mhm.
for them, right? Because here they got to come in, do all this work, do construction, and manage huge turnover and turbulence
Yep.
during a value add, and then when they do a good job, we sell the property and they get replaced. Like, what kind of
Yeah.
bad job is that, right? Like,
Yeah.
who
Yeah.
who in their right mind would want to take that on? So it's a constant battle finding good people who are looking to do this. And yeah, I mean, I don't blame I don't blame them. Um, but it's also keeps them honest, right? Like, I see some people, like, they'll bring in the PM firm and put them on the GP. Like, we've tried to do that too, but it just never works out. And then now when they don't perform, you can't fire them. They're stuck
Yeah.
in the deal and they become a
Yeah,
nuisance.
true. Yeah. Yeah.
So that's kind of my opinion. I mean, people got a good thing going on. Great for them, but I think also they also try to hide the fact that they are pocketing that 10% developer
Mm,
fee.
mhm, mhm. Well, not only that, but if you're an operator and you're doing your own property management, you're almost running a second business, right? Because on the property management side, now you're dealing with staff, employees, all of that garbage that goes along with that. So you're dealing with multiple individuals in one business, and then on the other side, on the investment side, you're dealing with, if you're the GP, you're running that side of the business plus handling all of your investors. It's a lot. Whereas if you offload it to a third party, you're kind of just, you're dealing with one so and so, one person in one way. Your rep with the management company, and if they suck, you could fire the whole team, and they plenty of management companies out there to come in and replace.
Yeah, yeah. Do you have more? I mean, I don't know. Do you have more operators out there or passives or what do you think? I mean,
I think it's changed in the last 2 years. I feel like from 2019 to 2024, 2023, I feel like, man, like everybody and their sister were trying to be syndicators and operators. And I feel like it's really fallen off in the last 2 or 3 years because when interest rates changed and all the bridge loans started to come due, the operators are not operating like they used to. There's very, very few that I come across that are still around that were around a few years ago.
yeah, yeah. A lot of broken websites, and look at
Yes.
their LinkedIn. They went back to a job, right?
Yep.
But I guess like the audience, would you say? I mean, I was gonna expand on the PM stuff a little bit more, but
Oh,
um,
audience wise, I think it's a blend.
okay.
I think there's a lot of people that are. I think there's people that come to me and they're like, "Hey, we want to invest. We don't know
Okay,
where to
so let me
start."
ask you this: like, how would you want me to expand to the audience, like on the PM front? Because I can go down two paths here. You want me
Go
to?
down whichever path you want. It's
You decide. Make it hard on me. Tell me which one to go down: the passive side or speaking to the operators. I guess.
let's go let's go passive side because I feel like
Okay.
on the
Okay.
passive side, people feel like they could just jump into a deal and they don't
Okay.
realize how much there
Okay.
is
Yeah. I
behind it.
mean, the whole talk between, do you go in house on a property management firm from the viewpoint of an LP? So like, you see a lot of these guys who will just um use that line like, oh, we have in-house, we're vertically integrated. It drives me crazy. If I ever heard that
Mm.
vertically integrated term one more time, I'd be a millionaire. But the what normally happens is like a operator who grows, and we were there at one time ourselves, right? Like the only like you mentioned, it's super hard to, it's just totally different business unit. The
Mhm.
only way what these guys don't normally do is they'll partner with another PM company, and then the principals will they'll hash out some type of JV. But in reality, all it is it starts off with a very loose like affiliate relationship, right? Like no
Mhm.
different than, hey, you refer clients over, we'll give you a discount. Well, at the end of the day, that discount goes to the other person, right, as some kickback or something like that. And yeah, like that's where, like, as a passive investor, like I never I've just seen it never work out well, because I just see them taking that development fee for sometimes work they hardly do, or half-ass work that they did, and it
Mhm.
becomes a big revenue source for the syndicator, right?
Mhm.
They, and maybe you see their fees on their acquisition fees go down, but at the end of the day, their fees on the development side go way, way, way up, right? So they're getting it
Mhm.
there. So it's a bit of a cat and mouse game for LPs. So just wanted to kind of point that out for folks. Like, I, like I said, we were there at one time trying to decide which side of the fence we fell on this ourselves, and and I still believe today, like, you look at the big guys, what they do, right? The KKRs, like, what do those big guys do? They typically will just do third party.
Yeah.
I think for the reasons I mentioned. The only exception, and I could totally be ignorant on this, right? I'm looking to the best foresight I have. Like CBRE, they've got a division where they run
Mhm.
their own stuff.
Mhm.
They're obviously a huge company that has the big brokerage side too. So you're humongous, these guys. So maybe it's obvious they would go down property management. But from the most part, I see them managing more like stagnant assets, like office space, right?
Yeah.
Different
Yeah.
clientele than your average class C, class B renter. So yeah, examples in the wild from past from from real operators, right? Like operators that are over 5 billion in assets. Like I see them going more the third party route with
Yeah.
this.
No, I agree. I agree 100%. When you're putting a deal together, or when you're working with a sponsor and they're structuring a deal, what kind of GP metrics do you typically look for from a sponsor's point of view? Like um, their carry, their percentage in the deal, their skin in the game. What do you kind of look for if you're investing as an
You
LP?
know, I'm the guy who tells people like that's the most silliest stuff to look at. You know, and I know everybody loves to talk about it, and that's where obviously the question comes from. But like,
Mm-hmm.
I think past investors need to really educate themselves on the stuff we were talking previously. Like, look, underrate the deal and care a little bit less on what the structure is. If you get a 90-10 split and zero fees on a crappy deal from a new operator, you can go ahead and invest in that. I would
Yeah.
rather invest in a fat structured deal for the GP, but have it be a fat deal overall,
Yeah.
right? Total return at the end of the day. Um, I mean, like, and this is where like it's the divide of there's a spectrum between good solid operators and new ones that are under $1 billion of assets. And I do believe, yeah, you don't want to work with new folks, and and you don't want to work with big institutions because you're, the deal economics. And I think that's where your question comes from, right? Like
Mm-hmm.
if an operator's taking 50-50 of the deal, that might be a little too rich, right? Depending on, unless it's an amazing deal, right? Don't get me wrong. I'm not going to disqualify a deal just based off the structure and the fee scheme. But typically with these larger institutions, they're going to name their price, and you as an investor may walk away with a less than an eight pref. I mean, like
Yeah.
well, I think one of the biggest people like idolize out there. Think he's the or they are the real estate investing apartment gods. And when you look at their deal, their structure is horrible for a passive investor. It's just a pref. You don't really get
Yeah.
upside in it.
Mm. Are you talking
Um,
about Cardone?
no, no,
Okay.
no. Um, I didn't really look at his deal. I think I don't remember on his deal, but that's an example of like a somebody who's not a huge track record, but they have a lot of investors, and then they can just name their price because their
Yeah.
investors are unsophisticated retail investors.
Mm.
But I think it's overall like I look at the deal first, right? And then on the deal level, and then it obviously goes through splits and fees. But if you're around like anywhere from a 50, I mean, I think 50-50 gets a little rich. I want to answer your question and not just defer it, but like, yeah, if the GP takes more than 50% of the split, um, I think it's getting a little rich for them, but I certainly think like a 70-30 is fair. So
Sure.
somewhere between there. Of course, they have to have, dozens of projects in the bag. But investors, some investors like when I started, would get involved with these like multifamily groups, and they want to invest with somebody who flipped four houses and now wants to take down a 300 unit. And because they liked getting a 90-10 split. I'm like, okay, cool, buddy. Um, and that might be a decent risk adjusted return. I don't know, right?
Yeah.
I do know, I mean, just to draw like so like the size of your operator, the track record, you're not going to get as good of a deal at the end of the day.
Mm-hmm.
And again, it comes down to total returns. Just for comparison and discussion's sake, like lately I've been doing a lot of oil and gas, right? And what's interesting, it's flip-flopped in that world, right? Like in the apartment world, I do think that it makes sense to work with more of a middle market. So like somebody in the middle of that paradigm I mentioned, right? There's a sweet
Mm-hmm.
spot. Somebody with, a couple billion of assets, several dozen deals, right? Maybe doing a 70-30 split, not gouging fees yet. And but in oil and gas, it's interesting is because the land is where the oil comes from. it actually is like the best land goes to the people who pay the most and the biggest firms. So your Chevrons, your Exxons, those guys, your Oxys, and those are the deals that you probably want to get into, right? The best deals. You want to, go to those get an allocation from that. I made the mistake. I didn't know this concept, right? In 2019, I just invested with a little cowboy with
Mm.
I don't know, he think he had like several dozen of these wells, but he's a small cowboy because I thought I was like, oh, I'm going to more grassroots. I'm buying from the farmers market, cutting
Yeah.
out the middleman,
Yeah.
because this is how it works in multifamily, right? This
Yeah.
concept,
Mhm.
um, but in oil and gas land, it's a complete opposite. You want to be the big guys because they have the best land, and that's where that has the best oil, and they have the best technology to horizontally frack that thing to no other. Where
Mhm.
the small guys, they got the crap leftovers of land, and they don't have the technology to extract it. And yeah, you take on all the risk of an unproven operator who might just steal your money too on that
Mhm.
end.
Mhm.
So that's what's nice about oil and gas. It's like, well, I'm just gonna go to the name brand, right? The big guys.
Hmm. Hmm.
Um, it's kind of like that in like pre-IPO world, right? Like I got a allocation of XAI, which eventually turned into SpaceX before it went pre-IPO. But the way that world works is, I mean, to get into obviously those types of deals, like you got to have like 100 million plus, right? But you can get on the cap table on one of those guys who kind of shimmy out a small portion of their allocation, right? So you're in that circumstance, there's only one place to get that, right? It's going to there. It's kind of like there's only one place to get a Louis Vuitton purse, a real
Right.
one, right?
Right.
And
Right.
I think that's why people pay a lot for it. But multifamily apartments, you can get fake knockoff Louis Vuitton purses all over, figuratively speaking, right? And
Yeah.
they might be fine, right?
Mhm. So with the oil and gas, I've always understood that it's so speculative, especially like what you're talking about when you're working with kind of the smaller operators that are just trying to tap their own wells. I mean, what is that? I have so many questions about that. I mean,
Yeah.
one is if you're going to the big guys, aren't you, are the big guys doing these deals outside of just buying stock in the company, or how does that work?
No, I mean, you buy stock in the company and you're not going to get your intangible drilling costs and all your tax benefits, right? So you
Mhm.
gotta, when you buy stock, you're just going to get exposure to their company. You want exposure to the actual project, right? Or the pool of projects. So you got to get direct to the source. But when you get on that, the idea is you get a allocation from that project.
Mm.
But that's what makes it easy, like I'm saying, right? Like you don't have to bottom feed with all these cowboys in that world. You kind of go off of the people with the long track records that's
Mhm.
documented, right?
Mhm.
And
Mhm.
and so from an investment point of view, it takes out a lot of the counterparty risk issue and stress.
Mm. Mm.
So counterparty risk is like working with some yo-yo who just started yesterday, right? It just runs
Yeah.
out for your money. Now you're like, okay, well that's interesting, that's cool. Let me just work with the proven people because they're the best deals anyway. You know,
Mhm.
cool.
Mhm.
And that's why
Mhm.
I like that type of world. But I think like what you're saying is like the speculation comes from is like nobody knows what the heck the price of oil is, right?
Mhm.
So you try and like generally speaking, prices go between 60 and 100 or
Right.
90, right? Like I mean,
Yeah.
just like multifamily class C and Phoenix trades between 4 and 6, right? Like
Yeah.
that's
Yeah.
it kind of there's market cycles and it kind of bounces between that. I think with oil and gas, it bounces a lot where multifamily or real estate, it maybe improves a tenth of a cap rate point per year. And so, in 10 years, like this is what happened the last 10 years, and 10 years before that, it came down a tenth of a percent every year. So in 10 years, it came down a full cap rate point compression.
Mhm.
And
Mhm.
then it swings the hell the other way. And that's when
Mhm.
everybody
Yeah.
gets hurt. Whereas, oil and gas, maybe your undulations. I don't, and I mean, we're engineers. What do they call it when from the peak to trough or the peak to peak in the sine curve? Like, I don't know what that
Mhm.
is called, right?
Yeah.
But the whatever that is, it's like probably a shorter time period, like 3 to 6 months, where you go
Uh,
from top to middle, top to bottom. I mean, shoot, don't even get me started with Bitcoin, right? Like that mother goes up and
so
down, like
volatile. Yeah.
yeah. So that I think that's the issue with oil and gas. But I mean, if you look for projects that are underwritten the right way, again, similar to like multifamily, right? You're trying to look for deals
Hmm.
that have the right reversion cap rate, have the right rent escalators in there. And at that point, it's a gamble, right? I mean, that's what investing is. It's a
Yeah.
gamble. But if you take the viewpoint of like, all right, I like this asset class. I certainly like the tax benefits, right? Because I know
Hmm.
I'm gonna get killed there. And I just take my licks with the price of oil, whether it's good or bad. Hopefully it's good. Most of the time you just dollar cost average. And then, I'm talking to more sophisticated investors out there, right? Sophisticated investor loses money, and they
Hmm.
know, and they
Hmm.
learn. I mean, I've lost money before, and I come back and I learn.
Hmm.
So with oil and gas, I mean, it's one of those things. It's very simple business, right? Like, I mean, there is a misnomer with vertical drilling. I think that's like 20 years old. That's
Mm.
archaic, and which is great. I love it because people stay away from it because they think you're just wildcatting out there. Um, but yeah, that's the price of oil is the speculative part. But you just for the most part, historically, it trades in a band.
Hmm. What kind of returns do you typically see with oil and gas? And what's the tax benefit look like?
Usually I mean, most of these deals are pretty much the same out there on the top tiers. So, like, usually you're trying, the tax benefits is the big variable for people, right? Because if you're in a lower tax bracket, you may only get like 20 cents on the dollar for every like, $100 or dollar of
Investment.
cr- or deductions, right?
Mm.
Whereas the high income earners, I think it makes sense for high income earners, right? Like you're in that 32% plus, or especially if you're in California, right? That tax on another 10%.
Yep.
So, those people, assuming you're kind of on that side, which most people are out there making over $400,000 a year doing this stuff, you're, you probably will see a nice little pop that first year. And then what's cool about oil and gas is you have the flash production, right? Like, yeah, you're horizontal drilling, but you still have a lot of the production in the beginning, like the first year.
Hmm.
And so it's the complete opposite of multifamily investing because multifamily investing is now the opposite. Like you barely get freaking anything the first year or two, and then it
Right.
kind of goes up. And then most deals these days, like only 1/3 of the projected returns are coming through cash flow, if that.
Mm.
Majority of it is through the value add, right? The NOI
Yep.
bump.
The exit
So
part. Yep.
so oil and gas is actually the opposite return profile of apartments. From a total return standpoint, I think it's very similar to multifamily.
Really?
Very
Huh.
similar. But the whole difference is that when you get the money is the complete opposite. So your IRR is way, way better.
Mm. Interesting. So if you're
Right?
smart, you could take that upfront cash flow from the oil and gas and just throw it right into real estate and just make this big cycle.
Or buy more freaking oil and gas, right? Like, if
Yeah.
you put in 100 grand and you got like, like 100 grand of deduction. I know that's more aggressive side, right? But just for math's sake, and that's worth 40 grand to you in
Mhm.
tax savings. You could put that 40 grand and buy some more or go, put into debt or something like that. Or,
Mhm.
but
Mhm.
I mean, for you to get 40 out of 100 grand, for you to get 40% return back on your money, shoot, that's probably more than cash flow you're ever going to get in that freaking investment, holding that thing for 5, 6 years, right? Like
Yeah. Yeah.
the only way you're going to get that is if you get lucky with a refinance year two or three. So,
Yeah.
but, again, I think all this, I mean, again, I'm not, as I mentioned earlier, I'm not giving anybody financial advice, right? But
Yep.
like I mean, I don't know if it's wise to have too much of oil and gas, right? Like some people really fall in
Mhm.
love with this stuff. I have
Mhm.
I have I have a client that he just does oil and gas, and his portfolio is like majority oil and gas. I'm like, hey, dude. I don't know if that's diversification, you know?
Hmm.
And I'm
Hmm.
the guy to talk, right? Like I had majority of my money in commercial real estate at the peak of the market in 2021, and I got my ass kicked. Luckily, I was diversified in good projects prior to that, right? So I think that's the other part of investing is you diversify and time dollar cost average, whether it's multifamily, etc. But live to fight another day. But that was my lesson learned, right? Like I want to
Hmm.
be diversified into different asset classes.
How did your investment with that cowboy turn out in 19?
I don't know. It's still going. I don't really pay attention to it, to be honest.
Okay. So now you're getting into buying businesses, you said?
Yeah, yeah, and actually, I gotta jump here. I got another
Sure.
call starting. But yeah, like I think that's long story short. I mean, I still love real estate. Long term, real estate has a good thesis, especially with the rich getting richer, the poor getting poorer, and this shrinking middle class. But I mean, look where the interest rates are going. Like everybody needs to have the CME FedWatch tool and the Chatham Financial Curve bookmark on their computer, check it at least once a month. And they're saying that interest rates are going to be going up from here. So that doesn't bode well for real estate. And if
Hmm.
anything, um, you know, take a look at your portfolio and imagine if something were to happen, how would you bode? Are you diversified?
Right. Lane, I really appreciate you coming on. I know you got a jet. Where can everybody find you if they want to try and learn more about you or invest in some of your deals?
Yeah, they can check out my book, The Wealth Elevator. I talk about kind of getting to that end game goal, 5 million net worth. There's a few stages before that. We have a pull-out table in the book. If they buy it on Amazon, shoot us a screenshot of the review and send it to team@thewealthelevator.com. We'll hook them up with the PDF version. I know the smart people are putting that into their chat GPTs. And then we'll hook you up with the MP3 version. So if you're like me and can't read it too well, I'll read it to you. But yeah,
Awesome.
thanks for having both accredited investors out there, Lane at thewealthelevator.com. We can jump on a quick call.
Awesome. Thanks, Lane. Appreciate you coming on.